Hi, this is Chris with Invest LYH, and I'm going to go over a quick property today just to showcase that the rents above mortgage are not always an indicator of positive cash on cash return. So let's go ahead and share the screen here, and we're going to go ahead and take a look at the property. So you can see here that we're looking at 1011 McCausland Street in Lynchburg, Virginia. This property, I believe, just came on the MLS today. I saw on Zillow, and I thought it'd be an interesting property to take a look at. So you can see here that the list price is $174,900. It's a 3-bedroom, 2-bath, 1,400 square foot, just your plain normal home in anywhere USA, right? So let's take a look at the numbers. I pulled up a couple of rentometer numbers here. The first one was from 12 months back, and you can see that right here. Oh, give me just a second. You can see here that we have 12 months going back. And what we have is we have this as our rental price. I usually go by the median, so 1150, but you can also go by a different one, the average, or depending on the property. So if it's a nice property, I will go by the 75th percentile. But just to always start out, I always just go by the median. So that's what I'm going to take a look at here. And 12 months back, the median was 1150. If we were to look now at the 3 months back, you can see here, it's still 1150. What does that tell me? That tells me that rents in this area are flat. Excuse me. They're not increasing, but they're not decreasing, but they are flat. So keep that in mind as you're looking at a potential income property. You want to make sure that the rents are rising, and you want to make sure they are not declining. So now let's jump right into the math. I'm just going to pop this up over here. Let's take a look at our sales price, $174,900. 20% of that is going to be $34,980. So that's our denominator, right? $34,980. Our rents are going to be $1150. Our mortgage is going to be roughly $990. That's assuming a 5%, 5.1% interest rate, I believe, 5.125% interest rate, I believe. All right. So based on our rents, our property management is going to be 10% of that, so 115, and then 5% for vacancies and 5% for repairs. So we're going to be pulling in at 58 and 58. Taking all of these numbers together, we've got 1221. Now, you don't need to be a math major to see 1221 is greater than 1150. So let's go ahead and subtract the 1150 from the 1221. And we're going to get 71. I should be writing that in red because that is how much this property will cost you each month. Because if we were to reverse this, right, and we did 1150 minus 1221, we're getting negative 71. So now we take negative 71, we multiply that times 12, and we get negative 852. Take that number, pop it up here, negative 852 divided by $34,980. Our cash on cash return for this property is going to be negative 2.4%. Now, you might see some people in the bigger pockets community that say, you know what, it's okay to have a property that has negative cash flow. I am not one of those people. I feel like you can find another property here that has positive cash flow, and that you're going to get all the other benefits, the tax write-offs, the appreciation. You're going to be able to get all those benefits in another property but it's also going to cash flow positive. It's also going to give you a return on the cash that you put into the deal. But I wanted to show this one because I wanted to show that you guys, let me stop sharing here. I wanted to show you guys that just because a rental price, the $1,150 in this example, is greater than the mortgage rate, which in this case was $990, it doesn't necessarily mean that it is a good cash on cash return property. So I hope this helps. If it does, go ahead and hit the like button. Let me know if you guys have properties out there that you want me to do a cash on cash return analyzation for. I'd be happy to do it. So thanks so much. Have a great day and continue watching our channel. Thanks so much, guys. Have a great day.